Good morning. Welcome to our webinar this morning. My name is Jim Gaines. I'm the Chief Economist here at the Real Estate Center, and we're here this morning to talk about what's going on in Austin and around the state in terms of the economy and the housing market for 2018. I thought I'd start us out this morning and get a little bit highbrow with you. Newton's law number one on inertia and motion. That's a good place to start. We're all real familiar with that, I'm sure. But basically it says an object at rest stays at rest, and an object in motion stays in motion at the same speed and in the same direction unless some other force intervenes to change it. And at the Real Estate Center, we've started going into more and more in the direction of trying to estimate and forecast and project what's going to happen in the future. So what we're looking for and what we're really going to talk about are maybe what some of these other forces might be to intervene in our economy and in our housing market to change the direction of where we're going and how we're going to get there and how fast we're going to get there. I'm going to start with a broad outlook on the U.S. economy and what we're anticipating happening this year and so on. And I know that one of the first things that everybody's concerned about, and it's uncertain at this point, of what the impact is going to be of the new Tax Cut Jobs Act. The Tax Reform Act that just got passed here in the last few weeks, especially in terms of real estate and housing. There are two or three main parts to of the act that are going to have direct or even some indirect impact on the housing market. One, of course, is the mortgage interest deduction. It stayed in. All they've really done is reduce the maximum amount of mortgage that you can have to deduct the interest from your income tax from $1 million to $750,000. And quite frankly, in the big scheme of things here in Texas, we don't have that many houses that have $750,000 worth of mortgage or better. It's less than about 3% or 4% of the total market. So in that sense, the mortgage interest deduction is still pretty much there. Now, for those of you who might be more active in the higher price properties in the luxury market, maybe over in the hill country and you've got multi-million-dollar properties, that may come up as an issue in terms of that mortgage interest deduction, but I don't think it's going to have that big an impact. First of all, the mortgage interest deduction has generally never been the main entry or the main interest of people buying and selling houses, even the more expensive houses. It's on down the list of important items, so it's there. The other, though, that's more important for most of us here in Texas is going to be the limitation on the property tax deduction if you itemize your deductions, and that's a $10,000 limit. And it doesn't take much in the way of arithmetic here in the state to figure out that what we're looking at is our houses in the state that are appraised at somewhere around $350,000 to $400,000 may indeed have a $10,000 a year property tax bill, and of course anything higher than that. That's going to be perhaps the bigger impact of the two. But the offset is the standard deduction getting doubled to $24,000. So it's a give and take. A lot of people who have been itemizing their deductions and taking the interest and taking the property tax simply won't. They'll take the standard deduction instead. Again, the after-tax effects on the decision-making in buying and selling houses especially generally is on down the list of things of importance. I'm sure your buyers and sellers are going to be asking you about it and to explain it, but that seems to be what the big issues are. There's some other technical issues. The pass-through provisions for investment properties will favor corporate ownership instead of partnerships, and a few other things that are going to come into play like that, but those will be the two. The other is the Tax Reform Act was supposed to increase productivity and add to the general economy, the growth, and help promote employment and wage gains, which is a big issue. The fundamentals in housing, of course, are population, employment, and income. Yeah, those three things are the driving forces behind housing. If the tax cut does, in fact, stimulate the economy and so forth with jobs and income and wage increases and so forth, then the housing market is going to overcome whatever those minor negative impacts are going to be about the deductibility of interest or property taxes. Other states in the union are hearing more impact because of the limitation on state income tax and those kinds of things that add to the total deduction package. We don't have that here in Texas, so it's not that big a deal. GDP growth at the U.S. level has been modest at best for the past 8 years. If you're not aware of it, we just celebrated the 10th year anniversary in December of the beginning of the Great Recession. It began in December of 2007. So in December 2017 was the 10th year anniversary, and we're really just now actually recovered, if you will, at the U.S. economic level from that Great Recession. Growth has averaged about 2.2% a year in GDP growth. To give you a perspective, the average since World War II has been about 3.4% a year, 2.2%, obviously a full percentage point and better, lower on average than that average long-term rate of growth. So it's just been very, very modest. 17 is, I've got it on here, it's about 2.7. I think it's going to be lucky to be that high. I think it's going to be closer to about 2.5, maybe 2.4, something in that vicinity. And I'm being generous in 2018 to give you the perspective. We do expect 2018 to be a better year, maybe approaching the 3% level. Really one of the critical elements will be how well we do here the first quarter. The first quarter of the last 5 years has always been the worst quarter of the year in terms of economic growth. Interest rates, yeah. Interest rates are likely to rise. I'm going to talk a little bit more about that. So what I've got is likely to rise, and like most prognosticators, maybe. We'll have to see. Inflation is probably going to hit that 2 to 2.5% level. That's important. We got to watch that because the Fed is watching that, and they will act or react according to what employment and inflation do in terms of raising interest rates, in terms of how much and when. So we have to watch that. We don't think inflation is going to get out of hand, but it's probably going to come up in that 2, 2.5%. Industrial production is doing well. We're being very productive. Productivity has been modestly growing, but it is growing without the help of adding jobs. We're substituting capital, robots, artificial intelligence, all kinds of technology for employment. So the industrial manufacturing side has been sort of a neutral positive on there. Housing at the national level, if you're not aware of it, housing has not recovered in the 10 years from the Great Recession. And when I say housing at the national level, read particularly new home construction. We'll be building about 700,000, 800,000 new single-family dwellings this year. We should be building, and our long-term average is to build a little over 1 million, between 1 million and 1.1 million. So we're still about 30% below what our long-term average is for new home construction. So while housing is improving and adding to some growth there, it's not the real stimulus that it's been in the past. And jobs at the national level are still going to continue. Here's a picture of what it's looked like in the past. Texas, as you can see, the red bars are Texas. Texas has done so much better than the national economy over the past several years, even in the down years of 2008 and 9, where you see the dips there in the blue bars and the U.S. economy dropping. You'll see that the Texas economy didn't drop anywhere near as much, and then we rebounded a lot quicker. Now, in 2016, yes, we had our little dip down. That was the effect of the energy prices going down. We dipped down below about 0.5%, but we've rebounded very well. 2017 is probably going to be somewhere in that 3.5, 3.6 area, and we're actually expecting 2018 to do even better than that and be maybe in excess of 4%. Nationally, employment and monthly changes in employment, that's what the blue line, the squiggly looking line is. And I gave you that on purpose. I wanted you to see that on a monthly basis, when you read in the paper and the monthly reports about how many jobs were gained or lost in a given month, the month-to-month numbers are pretty volatile. They go up and they go down. And some months, for example, in the past year, were as low as 38,000 and as high as 260,000 in a 1 month change. So the 1 month number sometimes really doesn't tell you that much. The red line, and there's a 6 month moving average, which kind of smooths that out a little bit, so you can see which way employment is really trending. You can see it actually for the last year and a half, though. it looks like it's a little bit negative. It's a little bit downward trend, but by and large, we view that as being fairly steady and in pretty good shape there. The inflation I mentioned a minute ago being in the 2 to 2.5% range coming up. That's what we think the annual rate. This is a monthly chart. But you can see in the shaded area, that's that target area that the Fed is looking for and where they would like inflation to be and to stabilize in there. The Fed gets real nervous if it gets too much above about 3, and they get extremely nervous if it gets below 1. Deflation, the opposite of inflation, is even a worse problem and a more difficult problem to solve than inflation is. In fact, you can see where it dipped down to 0 and actually dipped down below 0 during our Great Recession. The Fed had no idea. No, economists can't tell you how to fix that, to be perfectly blunt about it. That's the thing that just takes time. You have to grow out of it and come to it. Consumer confidence, the economy, of course, is based primarily about 70% worth of GDP growth is based on all of us doing our patriotic duty and going out and spending 110% of what we make every year. And Americans are very good at doing that. So we spend money. So we watch these kinds of indexes to see what the overall attitude of consumers and the American public is in terms of going out and spending their money and so forth. And what you can see is on the far left of this chart, that blue line, which is the U.S. rate, that's a historic low. I mean, that's no confidence in the economy at all. And that was the Great Recession time period of 08-09. Since then, you can see how it's been on the rise. Texans have always been more optimistic. I mean, after all, we live in Texas. Our dip down occurred in 15 and 16. You can see the little dip down. That was when oil prices went down and the energy industry cut back. Since then, been going back up again. Small businesses, Main Street businesses, the companies, and incidentally, the government definition of small business here is companies who hire less than 500 people. So some of these companies are still, by our standards, still pretty good sized companies, but they're not the Exxons and the AT&Ts and the really super big companies. What you can see there is that their confidence has jumped way up, and I can tell you exactly the date that big jump there you see in the line started on November 10th, 2016. A date that should ring a bell. It was the day after the election. And that's the Trump bump. If there was a Trump bump, that was it. And in fact, I'm going to show you another one in just a minute. And you can see how small businesses got more optimistic that things were going to be better for them. They were expecting the tax reform. They were expecting regulatory reform. They were hoping for more government spending in contracts. Basically, they were hoping for easier credit terms and monetary policy, the continuation of very, very low interest rates so their cost of capital was low. All of these things added to, and at the time, the offset or change in the Obamacare, the Health Care Act to make it more favorable, at least for the small business operator and cost-wise as well. Interest rates are always interesting, and of course what's been in the news lately is the fact that the Fed raised interest rates again in December and have announced that they're going to raise them again during the course of 2018 at least 3 times. Now, there's also some probability they might actually raise them 4 times. What I've tracked for you here is the Fed funds rate, which is the black line along the bottom. That's the rate that the Fed talks about every 6 weeks when the Open Market Committee meets and gets out in the newspaper. And that's the rate that gets all the attention. The orange line there across the top, that's the 30-year mortgage rate. I've used that as our measure of long-term rates. And what I've blocked out for you there are the previous 4 times that the Fed has made a significant increase in the Fed funds rate and contained it. And the first 3 there across from left to right, what you'll see is that when they raised the short-term rate, the long-term rate correspondingly went up. And that was the general theory, that if they raised the bottom rates, the top rates would go up as well. When they started doing it, though, in 2005, 6, and 7, you can see that the impact on the long-term rate was a lot more modest. it went up, but it only went up a little bit. It didn't really have the kind of uptick that you would have expected. And in the last go-round, when they started in December of 2015 on this current round of increasing the rates, and they're doing it now more stepwise, so it's taking a little longer to get those rates up, you can see it's had very little effect on the mortgage interest rate. In fact, the overall trend of the mortgage interest rate has been downward. Long-term rate coming down when short-term rate going up. Kind of opposite theory-wise than what we'd expect. So the answer to this coming year, if we anticipate that by mid-year, the Fed is going to increase the rates again, the short-term rate, the black line there, another 25 basis points. The question is, what is it going to do to the mortgage interest rate? Well, we'll have to see. Here's what that mortgage interest rate looks like for the last 6, 7, well, 10 years. And you can see how it's been in general decline. And we've had 2 periods of time, particularly when the rate has jumped up. The first time was back in 2013. This is when the Fed announced they were going to initiate tapering. Basically, for those of you who've been in the business, in 2012, 13, 14, and back into 9 and 10, the only reason we had a housing market at all was because the Fed was buying all of the mortgage-backed bonds from Fannie Mae, Freddie Mac, and Ginnie Mae. That's the FHA loans. And when the Fed said they were going to taper back from all of that, the interest rate started jumping up. That was the Fed tapering effect. And actually, it happened because of Ben Bernanke gave a speech saying we're thinking about doing it. He didn't actually do it. They just said we're thinking about doing it, and immediately the market jumped the rates. You can see that after the market got over its knee-jerk reaction and came back down, and then on November 10th, 2016, bingo, we had another spike in the rates. That was the day after the election. It's interesting that happened, that spike in the rate happened between November 10th and December 30th because the Fed didn't increase the short-term rate until December 20th. So the market had already increased the 30-year mortgage rate 20 days or almost 30 days before the Fed actually did its increase. And when the Fed did its increase, it was funny because the long-term rate started declining again. Now, the best guess is that yes, during the course of this year, the Fed will increase short-term rates about 75 basis points. That's 0.75%. It's going to relate to somewhere between a 25 to 100 basis point increase in the mortgage interest rate, we think. That's somewhere between the red line you see going out and the gray line going up. So what we're saying is by the end of the year, not the whole year, but by the end of 2018, we might see mortgage interest rates go from the current level of about 3.8, 3.9 up to about 4.4, 4.5, 4.6, somewhere in that mid fours, maybe as high as 5. I've seen several prognosticators say 5%. Quite frankly, I don't think it'll go that high. I think it'll be between about 4 and a quarter up to 4.5, and maybe bounce around in that area, and that's by year end. So incidentally, if you're talking to current buyers who are looking here when the buying season starts this February, March, April, we don't anticipate the rates changing all that much between now and then. Most of the rate changes that we anticipate coming are going to be more toward the middle of the year and then on into the end of the year. So for Texas, what we're looking at, 2017 was our recovery year. We had to recover from the 2015-2016 downturn in the price of oil that caused some economic slowdown in the state. 17, a very good year, actually, as you've seen here in the prior slides. And 18, right now, remember I was saying we were looking for those forces to move that object that's in motion in the same speed and direction. And we're not seeing any of those forces that's going to move it that much. So we're anticipating 2018 to be continuation and actually a continued uptick from where we left off in 2017. Here's a quick, I don't know how quick it is, but here's a summary of the Texas outlook. 2018 better than 2017, which is always good to be able to say the next year is going to be better than the last year. That sure be, next year when we're doing this speech, I don't know whether I'll be able to say that or not, but we'll see. Energy, healthcare, business professional services, even Harvey, the hurricane, which had some deleterious effect on 2017. It turned out to be much more minor effect on the overall economy than what was feared when it first happened. Houston and most of the industrial production, if you will, down in the Houston Gulf Coast range from Corpus to Beaumont, most of that recovered within a matter of 3, 4, 5 weeks, at least up to the 90% plus level. So the loss in economic activity and output was a lot more minor. Actually, it's going to reverse in 2018 because now all of the recovery efforts and all of the rebuilding and remodeling and coming back in after the hurricane and the fix-up is going to actually add to economic activity in 2018 and make it better. Probably the number one issue and the thing that we watched the closest in terms of one of those factors that could be an influence on changing the direction and speed of growth of the state is the national economy. And right now, as I just said, the national economy is poised to have a very good 2018, doing much better. And incidentally, the global economy is also doing a whole lot better than it was about 2 or 3 years ago. So like state to national to global economy, everything seems to be moving forward in a satisfactory level. Energy sector, all of those downturn effects are pretty much have already worked through the economy, lost jobs and lost productivity. Most of that is now coming back. Oil prices are approaching, in fact, they've actually already on the short-term basis gone and exceeded $60 a barrel. What we're looking at here in terms of approaching 60 is on a stabilized, ongoing basis and getting into the 60s and getting out of the 40s and 50s in terms of price per barrel. We don't anticipate that's going to have as big of impact. I'll talk a little bit more about that in a second, as you might think. Job growth is going to pick up. In fact, expect about 2.3. I think actually that's going to be better. I think it's going to be about 2.5, 2.6, 2.7%. And if we get real lucky, could even approach 3, depending on what we do with construction, employment, and so forth, like for the Harvey remodel and catch up and so on. Population expansion continues. Texas is going and blowing. I'm going to talk a little bit more about that in a minute. One of the things, though, that's of importance to you as real estate agents and people in the real estate profession, all of this growth is really good. The population expansion, jobs expansion, income expansion in the state, the housing market tight, houses being bought and sold, development going in place, but it's creating a lot of issues and problems at the local level, particularly for the public sector to keep up with infrastructure, public goods and services, schools, roads, all of those kinds of things, and then simply planning, zoning requirements, platting requirements, density codes, water and sewer codes, and so forth. All of these things are creating the kind of problems you like to have in terms of being created from growth and development and positive actions, but nevertheless, it's got to keep pace to make sure that it's balanced and we grow in the right way and have that quality of life that we're all looking for. And it's everything. It's state level, it's county level, it's city. It's down to the HOAs and the neighborhood associations enacting whatever acts that they're doing and subdivision codes and so forth. Rebound from Harvey is going to continue and contribute, as I just said. Here's what it looks like statistically. Job growth keeps going. 2017 for the state, we're going to be adding, in fact, the latest number is something closer to about 320,000 jobs during the course of the year. A very good rate of growth. You can see the step increases in those bars since we peaked out, or bottomed out, I should say, in about 2009 and have kept coming back. Here's what the oil and gas looks like. The blue line is the rig count, the active rig count, and this is the Texas rather than the total U.S. The orange line is the price of West Texas Intermediate. That was a maroon line until it started going down, so I changed it to orange. And now as it's come back up and started trending back up, I may come in and change this line back to maroon again. But what you can see is, and this is what I was talking about a minute ago, is the price of West Texas Intermediate. It's approaching that $60. These are monthly prices. not daily or weekly. And so we're looking for is that stability of the price going into the 60s, perhaps. The offset of that, though, is because of the increased technology and the level of productivity and the action of the E&P drillers and producers, they can produce more with fewer wells. So what's going to happen, though, even as the price goes up, they really aren't going to have to drill that many more new wells, because the ones they do drill, they're going to get more oil out of them. So they just don't have to drill as many of them. So that blue line, we are looking for it to go stable, sort of horizontal, if you will, at looking at this graph, or just gently upward, and not have the same kind of economic impact that we had when it just jumped up from near nothing and then doubled itself. Don't anticipate that in the future, but it's still better than going back down again. It has a meaningful input. And here's our clue for the future: the futures prices, the 6-month, 12-month, 2-year future prices that the traders are looking for the price of oil is less than the current spot price, which means that they're not anticipating that price to go way on up. They're anticipating it, in fact, to be kind of steady to stable, maybe even in the high 50s or low 60s, not going up to the $70 a barrel. That's our better indicator of where the future is likely to go, at least in the next 6 months or so, or 2 years, because those traders are with it all the time, looking at what they think the prices are going to do. Well, let's turn our attention to Austin, see what's happening over there. Austin, of course, really hadn't had a down year. While Texas had that down year in 2016, most of that was because Houston fell off, and the Midland, Odessa, and San Angelo, and Corpus, and some of the other energy-related metropolitan areas in the state kept the state statistics down. The high-growth metropolitan areas, Dallas, Fort Worth, Austin, San Antonio, didn't really feel the energy impact at all. Austin, like Dallas, Dallas, J.R. Ewing notwithstanding, Dallas is not an oil and gas town. It's funny because the rest of the world thinks that it is because of J.R. Ewing, but it's not. And Austin, as all of you know, the Austin area is really not oil and gas related. It's technology and business professional services and financial services, and that has not stopped at all. The rate of increase, we think, might slow down a little bit. So it's the increasing at a decreasing rate in economic speak, which incidentally, economics is just taking common sense and making it unintelligible. So what we're trying to do is talk about, we know it's going forward, we know it's getting better, but it's not quite growing. And in some respects, that's not a bad thing, because it's been growing so fast. Those problems that I was talking about, those local growth problems, we need to get those contained a little bit, and to slow down the increase would help that a lot. But you can see the job growth continues to go up. On a monthly basis, they had a little leveling off. The tech companies did a big job of moving in. They've leveled that off a little bit. But now the business professional services and healthcare picking it back up a little bit on a monthly basis. You can see how Austin was going and blowing a whole lot faster than both Texas and the U.S. in terms of rate of growth and employment and job formation. It's basically come back to sort of norm to the state level, and that's not a bad thing. For those of you who like the details, here's the November to November change in jobs and by category. Don't have the December numbers yet, but you can see it was 2.7% on year-over-year basis, about 28,000 jobs created. And it was interesting to me when I looked at this chart, put it together, retail trade. I can tell you that for those of you in the real estate business, and for those of you who do deal in commercial, on the commercial side, and as opposed to the residential side, the retail market in Austin is very tight. There's not as much new development of retail properties. The vacancy rate in retail is very low. Rents have been going up for retail space. Retail tends to be a very local thing other than the regional malls, and nationally regional malls are having a lot of trouble, and even the malls in Austin are not doing gangbuster, but the retail overall is a very good market, but the employment level in retail was down at least November to November. Especially November, November, December, generally retail goes up because it's Christmas season, and you get more employees on the temporary basis in the retail sector. So it was kind of interesting that came into play there. Information's not surprising at all. The rest are in pretty good shape and doing pretty much what you would expect. Austin, like I said, has been really the leader in the state as a metropolitan area in terms of economic activity, business activity, job growth. This is reflected in what's called the Business Cycle Index that's put out by the Dallas Fed. This is a composite index of overall business activity in a metropolitan area and then compared to what the state was doing. And Austin, its rate of change and its level was just off the chart. I can tell you that if I'd superimposed on here Dallas and Fort Worth and Houston and San Antonio, they're all down below. They're all much closer to the Texas line than the Austin. It's a magnitudes difference between Austin and the state and the rest of the area. I said I'd talk a little bit about population growth and demographics. Let's talk about that. Latest census numbers just came out just a few weeks ago. And between 2016 and 2017, 1 year period, Texas added just shy of 400,000 people to the population. 2015 to 16, we added 440,000 people. So in a 2-year time period, over 800,000 people added to the population base of Texas. About half of those were births over deaths. There was natural population increase. One thing about it, we're a young population, we're fertile, so we're adding more kids than people, and the good guys aren't dying as fast as the younger people would like, actually. The other half of that increase, though, is from immigration, and that's immigration both foreign and domestic. Foreign, obviously, from other countries. Domestic, people coming here from other states. The biggest single state sending us people, California. Those of you there in the Austin housing market, you know what I mean. We've had an influx of Californians, particularly interested in coming to Austin. A lot of the high-tech employment, attracting people from the California markets and from the state of California. In fact, the state of California leads the country in net out migration, more people leaving the state than coming into the state on an annual basis. It's time to get the hell out of Dodge, I guess. Texas population is now a little over 28 million people. Dallas and Fort Worth and Houston added over 100,000. Austin is now the 31st ranked MSA in the country. If you're not aware of it, Austin MSA is now bigger than Cleveland, Ohio. I always thought that was an interesting point of trivia, but just to give perspective, because most of us just think of that as being a large metropolitan area. Well, Austin is actually larger population-wise than Cleveland, and in fact it jumped over Columbus, Ohio and Cleveland, Ohio, jumping from 33 to 31 in the rank order of MSAs. Just thought you'd like the trivia for the morning. Here's what it hit, and since the beginning of the decade, since 2010, interesting in terms of the pattern of population change within the state. We did have almost 100 counties that lost population. And you can see the red, colored counties actually lost population. And where those people went, I mean, it's difficult to figure out. If you were living in one of those counties, if you're not running a family business, what are you doing? I'm not sure. Most of them were leaving and going to the urban triangle of Texas, the Dallas, Fort Worth, Houston, Austin, San Antonio area. And you can see the dark blue counties, the main population growth counties. And what you can see particularly in there is the I-35 corridor coming up from San Antonio, from Bexar County, Hays County. But then you see Travis and Williamson County both in the blue, and then on up into the Dallas-Fort Worth area, where a lot of that growth is growing, where the people are going. And there again, the housing market, fundamental to the housing market, more people, more households, more need for housing. And especially if they come in and they have money. And as we see, median household income is following a similar pattern. The I-35 corridor from San Antonio on up to the Dallas-Fort Worth area, but particularly through Travis, you'll see Williamson County particularly is one of the higher median household income counties on in. It's interesting to note that neither Harris nor Dallas counties are in that high category. They have more of a concentration of some lower income households. So the higher income households tend to be in the suburban counties around the central county for the cities and the MSAs. The exception, of course, is over there, and most people don't recognize it, out Midland, Ector County, that's Gaines County. I always have to throw that one out, that are showing up in the blue with higher. All three households out there, I guess, got a big pay raise or something from oil and gas. So it helps to have that kind of activity going on. Projected growth in Texas out to 2050. This is from the State Demographer's Office. Many of you have heard me speak before. I've generally given you the top line from the current population up to about 55 million or close to it. The increase of about 30 million people. From 70 to 2010, a 40-year period, we added about 14 million people. From 2010 to 2050, we're going to add perhaps as many as nearly 30 million people to the state's population, twice as many people in terms of change and growth. And these are different scenarios. That's 2010 scenario. If we grow at the same rate of domestic immigration as the last decade in the next 4 decades, then we get that kind of rate of growth. If we go at the 2010 to 2015 rate of immigration, then we get the purple line or blue line. And then if it's only half of the rate, we get the green line. So you can see that there's a range in there. I love making 40-year projections because 40 years from now, I'm not going to be here to have to defend it. So you're on your own. But it looks like it's going to be somewhere in that bracket and what's going on. Here's where it looks like people are going in terms, again, projected population change by county within the state. And what you can see is I-35 basically creates the difference between East Texas and West Texas. And really what it is the urban triangle of Texas, the I-35, I-45, I-10 corridors creating the edges, the boundaries of the triangle and the counties along them. Something like 87% of the population of Texas is going to be along that I-35 corridor east. 92% or 93% of all the growth is going to be east of I-35 corridor. So that's where the concentration. You can see a few exceptions out in the west: Lubbock, Amarillo, Midland, El Paso. A couple of three exceptions. Again, those white or light yellow colored counties in the middle of the state. Again, losing population even over the next 40 years. So we'll have to see how all that goes. For Austin, Austin's growth is going to be phenomenal. This is the MSA, which is incidentally the 5-county area that are listed there. We're looking at the population going from the current level of about 2.3, 2.4 million to as many as roughly 5.2 million people, more than double in the next 40 years. Austin is just going to be a terrific growth area. It will actually exceed San Antonio. It's going to become a little larger than San Antonio somewhere in the 2020s, late 2020s, if I remember where the crossover point is. San Antonio not growing quite as fast. It's growing also, but not quite as fast as the Austin market. This is going to be, I mean, there's your upside for the next 40 years for the housing market. When you're going to double your population, you're going to add nearly 3 million people in the next 40 years. Even if you just figured 3 people per household, that's 1 million households. That's 1 million houses, additional houses that need to be, housing units that need to be provided. Williamson County is even faster. Williamson County going from the current population base of a little over 500,000 to almost 2 million. Okay, almost a 4-fold increase in the population. A lot of that growth along that I-35 corridor is being attracted up to the Williamson County area. And Hays County, not to be left out. It's the fill-in, if you will, between San Antonio and Austin that Henry Cisneros, when he was mayor of San Antonio, many of you remember a couple of decades ago now, always talked about the Austin-San Antonio high-tech corridor. That's coming to fruition. Henry was just a couple of years ahead of himself. It really is filling in between. We're seeing it. Well, let's talk about housing. Now that we've talked about the economy, the people, the demographics and so on, what's the housing doing? Let me take you through some basic issues. We could talk for a couple of days on each one of these. These are things you need to know about. Demographics, just talked about it. And I didn't get into the difference between, for example, the demand for demographics from the baby boomers. You're looking at one. I'm on the leading edge of the baby boomers. Those are the good guys. Versus the millennials, the 20 and 30-somethings in today, roughly from 20 to 38 years old, millennials. Shift in taste, preferences, attitudes. The millennials have no stigma about renting and renting longer, not as anxious to get into the homeowner market. They're getting married later in life. They're having fewer kids. They're having the kids later in life. So the life cycle, which is generally the housing demand factor, is much different than it was for the baby boomers. We got married earlier, had more kids, had kids earlier, got into the homeowner market a lot earlier in life, in our 20-somethings instead of in the 30-somethings. But now that millennial generation's getting every year, it's getting another year older and entering into the housing market. Affordability is a big issue. We could talk a lot about this. Main challenge probably for the next years, decades here in Texas is going to be affordability. One of the key economic advantages Texas has had to attract all this growth is our housing market is very affordable relative to other major states in the Union. California, Florida, Illinois, New York, New Jersey, Delaware, name it. And Texas had very, and still has even to this day, very favorable and affordable housing. But that advantage is slowly eroding as the value of our housing comes up. And it's keeping the millennials out of house. They can't afford to buy the entry-level house. Can't find one, can't get financing for it, don't have the ability to save up the down payment. Mainly, or one reason, because of the student debt that they've incurred. Capital flows and lending requirements, interest rates, and lender attitude about lending. How easy or tight they make credit. We went through our socioeconomic experiment back in 06 and 07, actually 02, 3, 4, 5, and 6, and 7, where we basically gave money to anybody who walked through the door and could fog a mirror and let them buy a house. Well, today it's a lot tougher. FICO scores are tougher, debt-to-income ratios are tougher, and the Dodd-Frank bill, basically it started out with the whole premise is you cannot lend money to somebody that you can't document that they can repay it. The key word in it was document. I mean you had the lenders were on the hook if they couldn't show in a review where the borrower, in the lender's opinion, had the ability to repay the loan. They don't make the loan. That's where FICO score requirements and debt-to-income ratios come into play and so forth. Those are the things that are going to affect. Infrastructure, we've got major infrastructure problems coming up not only nationally, but here in Texas. We're sorely lacking in transportation, roads, public transportation, education. We've got communities in the state and in the Austin area, throughout Williamson County particularly, where you basically got to build an elementary school every year to handle the increase in the population load, and you're having to build middle schools and high schools every 3 or 4 years. Those are expensive. They're difficult to do. And then you've got the restructuring issue. So education, transportation, utilities, just providing water, sewer, electricity, all kinds of things there on that end. And then development. This is where a lot of the conflict is coming in between the local public sector and the private development sector. Density codes, mixed use, PUD developments, planned unit development, mixed properties. All of the resources, the processes, how do you build it, how to build it quicker, better, cheaper, faster. That's the American way. And we're fighting with that all the time. And then, of course, the regulatory issues. And this is everything. This is lending, environmental, land use controls, federal, state, local, you name it. We've been overly regulated, or at least there's the feeling of over-regulation that creates a constraint. You can see the effects in California. In San Francisco, median price homes, $675,000. Reason is there aren't enough homes. It's just so tight. And part of that was regulatory problems. Housing markets, I'm going to go through this real quick. Mortgages, I think, are going to go up about a half a point, maybe. Household formations, 1.25 million around the country. In Texas, we'll run about 125,000 to 150,000 new households. Sales volume is going to increase, but at a decreasing rate. It's going to go up. We'll see it. Prices are going to continue to go up. We've still got tight markets. Austin is a tight market. I'm fixing to go into it in just a second. Very tight market. Home prices are going to continue to go up. Rental market may be loosening a little bit. We've built a lot of multifamily. A shift in the millennials into home buying might take away some from the rental. We'll have to see. Single family rental is an interesting concept. It's now institutional. We have investors buying single family homes, home builders building homes to rent them, not to sell them. So we're seeing that single family rental market now adding another dimension to the housing market that we really haven't paid that much attention to in the past. Home construction may actually slow down in Texas. Texas is leading the world in home building. We built more homes in Texas than anywhere else in the country. Houston and Dallas, for example, the metropolitan areas, built more houses last year, both of them, than all but 4 states. So I mean, the home construction, and incidentally, both of those were only building at about their long-term average rate. So it tells you how low the rest of the country is doing as well. And affordability, of course, in the housing market is going to be a thing. Here's what's going on statewide. I just got the new, our preliminary year-end numbers yesterday, and I didn't have time to update the slide. But that orange bar out there will be higher, is higher than the green bar for 2017, so than 2016 rather. So 2017 is a new record year. It's going to be at around 336,500 sales. The median price, the average price, both the red line, the orange line, and the blue line are going to be up. Median price in the state's about $224,000. You know, and that's up a lot just in the last 10 years. That's where that competitive advantage I was talking about. And our months inventory, it's still right at about 3 months, 3.1 months at the state level. Very, very tight housing market in Texas. Single family building permits, you can see in Texas has been rising greatly. We're doing great. 18 is projected to be an even better year, although again the rate of increase is slowing down. But one of the reasons is we don't have enough developed land, labor shortages, material costs, and the time of construction. It's now taking, for example, ask any builder, a few years ago, if you asked him when he started construction, how long is it going to take you to build the house, he'd tell you 4 or 5 months. And today he's telling you 6, 7, 8, 9 months, depending. And just that time factor will slow down the total number of units they can produce in a year's time. We've measured it in terms of single family building per 1,000 new units. You can see we're running short. We're not producing enough new housing units relative to the number of new households that we're creating. And we're running short. Back of the envelope arithmetic, we're about 300 to 320,000 units short. That's the reason we've got this 3 months inventory. That's the reason prices are going up as fast as they're doing. Multifamily, we tried to predict or pick up the market and build more multifamily housing. That's slowing down mainly because the lenders are backing off of the multifamily. They're nervous now that maybe they've built too many and that the returns won't be there, so the lending isn't as easy to come by. And developers are getting nervous. They've seen vacancy rates rise just a little bit, a slowdown in the rate of increase in rent levels and that sort of thing, so it's slowing that market down. We have developed a Texas residential construction coincident and leading index here at the Real Estate Center. We put it out every month in our Texas monthly housing report, which incidentally is coming out tomorrow or the next day, as soon as I finish editing it. It's sitting on my desk right now. But you can see that the leading index, the red line, has turned back up. That means in about 6 months, we'll expect that blue line, the total housing permit line, to also turn back up. It gives us an indicator of where we think the market is going. Let me get into Austin very quickly. I got a few minutes left here. Austin, I also have the end of year numbers. 17, record year in Austin for home sales. I didn't have time to add it to the chart. You can see in 16 we had about 32,900 sales, just shy of 33,000. It's going to be about just shy of 34,000 for 2017. So again, stepping on up on the bars there will be another record year. That's about a 3.7% rate of increase, which again, a little smaller rate of increase, still positive, but not quite as big a jump as what we've seen the last 2 years. On a monthly basis, the December sales came in close to right at the 3,000 unit mark. So again, that dark green line that you see there, which is the 2017 line, and how it has exceeded. You can see the seasonality of sales, and the year-to-date number is going to be something pretty close to about 3.5, 3.7. Months inventory still hovering in that 2 to 3 month level. Right now, the official number is about 2.1 for the MSA, and that's basically no inventory. It's a just-in-time inventory. Some of you are probably going to be able to give me anecdotal stories of how you're able to list a house today and sell it tomorrow or within the week, maybe even with multiple offers. And it's that kind of a tightness in the market. You're probably having trouble dealing with some of the buyers that you're dealing with in terms of giving them enough different properties to even look at and to consider and in their purchasing decision. Here's how it kind of breaks out if you look at it by price category, incidentally. I'm not sure how well the slide is showing up to you, but basically you can see on the left-hand side, the blue bars is the number of sales in November by price grouping, and what I've got circled is from 150 to 750 market, and you can see that's where the bulk of the sales are, of course, which is kind of a duh. You know, you could have all told me that without the slide. But you can see the month's inventory corresponding to each price category. And you can see that, for example, less than 250 is less than a month and a half, basically no inventory at all. And even for the 250 to the 500 is less than 3 months. So again, very, very tight market conditions. Very few sales for under 150,000. There's a few in the 100 to 150. Those are generally out in the extreme suburban areas of the 5-county area. But you can see how that marks up there. Median home price in Austin. Austin is, on the median basis, is the highest price market we've got in Texas among our major MSAs. 2017 is going to be up about 5.5%. In fact, it's going to be instead of the 294 there on the green, but it's going to be about 295 after the December numbers came in. That's very preliminary. Those numbers will change again in the next couple of months as we get all of the final data in through the MLS and all the sales data and so forth. But it's going to be in that ballpark of about 295. I mean, approaching 300,000 as the median home price in the Austin MSA. Here's what it looks like if you look at a simple linear trend line on a 12-month moving average, which gets rid of all of the volatility in the pricing. You can see how that median home price for the last 2 or 3 years has just been going way, way above average rate of increase. And at some point, that's going to bend over. You almost want it to. You don't want it to continue up at that level because you just start pricing yourself out of the market and making housing so difficult. On a price per square foot basis, you can see how Austin is considerably higher than the state level for the median price per square foot. And again, it's the general upward trend and movement. The monthly numbers are even a little there. In terms of sales distribution over the last 6 years, you can see in 2011, for example, in the Austin MSA market, 2/3 of the sales in Austin in 2011 were less than $250,000. But today it's only 40% market share. So it's gone from a 2/3, 1/3 to 60-40 to the upper priced market. And that's not even into the $1 million plus homes. That's just the up to $1 million. So we see how that goes. In terms of sales by price intervals, it's interesting. There are more high-priced, over $750,000 price homes being sold than under 150. The two squiggly lines across the bottom of the chart there. The preponderance of sales, no surprise. Between 200,000 and 750. Again, that's no surprise at all. and you can see how the 400 to 750 it was so predominant there. In terms of active listings, the number of listings, the predominant is between 300,000 and 400,000. That's that top black line on there. And you can see how the others are standing up. The month's inventory, the very expensive homes, plenty of inventory there. There's better than 8 months. And in fact, in some of the other markets, I can tell you that's closer to 12 and 13 months. So actually, that's pretty low by comparison. But look at it. You can see that all but 4 of the price categories are less than 3 months. So that's that tight market that Austin area is experiencing. Williamson County, here's what it looks like up there. Home sales have increased almost 68% since 2011. Home sales are up about 4% for 2017. They're going to end the year another record year. Current month's inventory about 2.4. Again, tight housing market in Williamson County. A lot of new homes, a lot of new home construction. Of course, up there in that area, in the Leander, Cedar Park area, and up in through there, we'll have to see that. Median home price going up close to $270,000. It's up over 50% since 2011. So if you bought a house in Williamson County in the last 5 years, you've done well. If on the median, it's gone up 50%. So that's you might be able to use that. Hayes County and likewise, home sales have almost doubled down in Hayes County, down in the San Marcos area, down on the south side. 2017 will be the same thing. Current month's inventory about 2.9 months, right at 3. Tight market. Median home price going in at about $257,000. It also is up nearly 50% since 2011. So both of the suburban counties doing very well. Travis County is more difficult because it's so mixed in Travis, but the 2 suburban counties particularly doing so much well. Here's what it looks like on a heat map basis in terms of change in home sales from November of 16 to November of 17. This is not the total year. It's just November compared to the previous November. And you can see that it's slowed down on the far east in the Bastrop and down in the Lockhart area, but by and large you see a lot of green and light green in there, so sales were pretty much up. Home prices in similar fashion, pretty much up. A few areas, that again the Bastrop area down just a little bit, but I suspect that's going to change a lot in the next couple of years. Dripping Springs down a little bit. If we look at just Travis County, you can see home sales have been pretty much up with the exception there at Barton Creek, and then down on the southeast side of the area, but the Pflugerville, Manor area up. Okay, if you can see the blue dots in there on the chart, I'm not sure again how well it's showing up on your version, but the blue dots are where the actual sales are. We now have the capacity with our partnership with TAR to get data and actually geocode the sales and be able to plot them on a map and see where they've occurred. Percent change in home prices, you can see more or less across the board they're up. Barton Creek area down a little bit, and a couple other individual areas. Williamson County home sales concentrating that Cedar Park, Leander, up into Georgetown area, little slowdown over out by Taylor, and then in the far reaches of the county up to the northwest. In terms of percent home change or home price, the green again predominant, some of the light orange or whatever color that is out again in the Taylor area, but you can see Round Rock, Cedar Park, Leander, Hutto, even into Georgetown, generally prices going up. Hayes County, very similar. Home sales. San Marcos area has been picking up. Wimberley is finally getting over the floods of a few years ago and recovering pretty well, and sales activity out there picking up. So we'll have to see. Buda, the prices are up, but the sales volume down a little bit, but generally property values up. Dripping Springs down just a little bit. And again, this is unique to that month, so from the year earlier. So those are not the year trends, it's just for a snapshot of what it looks like. Well, that brings us to a conclusion of where we are in terms of the direct presentation. I've really enjoyed being able to do this with the audience that we've got, and as I understand it, we have been taking or have taken in some questions, and be happy to answer any of them that I can.
Our first question comes from Maggie. She has a question about the $24,000 standard deduction. She asked, will that mean we will not need to itemize our deductions as real estate independent contractors?
I'm not sure if everybody can hear the question. The question was to talk about the standard deduction going to $24,000, and does that mean that as independent contractors and agents, we won't have to itemize? You're going to be just like everybody else, quite frankly. It's going to be the arithmetic of how much interest you're paying and what your property taxes are and how it compares to the $24,000. And being an independent contractor, you have business expenses and stuff, other things you can do that maybe a W-2 employee doesn't have. So that'll weigh in. It's impossible to really say categorically that you will or you won't have to itemize or it'll be better off one way or the other. It'll be based on your individual circumstances.
Polly has a question regarding the Tax Reform Act and the Texas economy. Have there been any changes that will affect real estate investors and also tax-deferred exchanges?
The question was, has the Tax Act changed? Will there be any change in the nature of investment properties in Texas or tax-free exchanges? Did I paraphrase that correctly? The tax-free exchange, as far as I know, is still intact, the 1031 exchange. So the new tax law has very little difference there. There were some technical changes on investment properties and passive pass-through that may make subchapter C corporations preferable to sub S corporations. And if you don't understand what I'm talking about these are technical changes. Okay, they're going to favor REITs. We may see some more institutional investing coming in the form of REITs and investment funds coming into the state. In terms of affecting a local investor, a local buyer, it may change a little bit their legal structure of how they do their investment, but it won't change really the investment itself, the pricing or the technique or the financing.
We have another question about the Tax Reform Act. This is also from Maggie. Has there been any change in owning a home 2 of the last 5 years? I understand there was a proposed change that would change it to 5 of the last 8 years.
Okay. The question relates to, again, the Tax Reform Act. And basically, I think if I'm interpreting the question correctly, capital gains treatment and how long you have to have owned the property and occupied it in order to take the capital gains deferment. And as I understand it, they did not, they actually, I think they lowered the number of years from 3 to 2 or something like that of the previous 5 years that you have to be there. Don't call, I'm not a tax expert. Call your tax advisor. That one I'm gonna pass a little bit on and tell you that I don't think that the change was substantial, but I think there might have been a little tweaking to it. But the key is, for primary residents, you still get the same amount of exemption or allowance on the capital gain without having to pay capital gains tax on it. They've also changed, and again, this is going to be real technical, and you'll need a tax advisor on estate and estate planning and wills and how much you can leave in your estate when you die. And of course, for most of us, the biggest single asset we own is our real estate and our housing. And it's now very high before estate taxes come into play. If you're not I think it's like $10 million. So it's in that sense, some of the Tax Act helped on the estate planning and on the capital gains treatment. Now on investment properties and non-primary residence properties, the capital gains treatment didn't change to my knowledge.
Sean wants to know, will the property tax deduction and interest deduction be per property or per owner? In other words, do the new limits negatively affect an owner of a home and multiple rental properties?
The question is, do the changes in the interest deduction and the limit of $10,000 on the property tax affect multiple properties or for each single property? And the question went on to say, you know, as your residence as opposed to investment property you might own. Investment property is a whole different category. The $10,000 property tax deduction is only for your primary residence anyway. The $10,000 limit, or the limit on the mortgage interest deduction on a $750,000 mortgage, is primary and secondary residence. So if you own investment property or income producing property, that's a whole different category, different tax treatment as opposed to a primary residence or a secondary residence. And most of you are aware that if you have a secondary residence and you occupy it or you rent it out a proportion of the time, it shifts into the category of being an investment property and not a second home. So that's how that gets separated. Again, for any of you individually, you'll need to get with your tax consultant on the details of that. But the general answer is the tax law and the mortgage interest deduction and the tax limit of $10,000 is for primary residence and or secondary residence. Any kind of other property you own that's investment, rental property, and so on, the whole different category, you get taxed. That's different. That's income producing assets.
No more questions.
We thank you very much for joining us today. This was an interesting way to be able to reach out and address a vast audience in different locations. We appreciate very much your tuning in to this session, to this webinar. We'll have to see if we can do this again. Hopefully I'll be better at it as well, and we'll be able to share our information with you again. Thank you very much for joining us, and at this time I think we're finished. Have a great day.